So what is wage and means advance? Wage and means advance is basically a short-term advance which is given by the central bank, that is RBI, to the central government, right? So RBI or central bank is the banker of the government. We already know about this. Many times the government balance with the RBI comes to negative. That means it comes below 0 rupees. So in such cases, RBI makes the payment on behalf of the government by giving the advance to the government. So this advance is called wage and means advance. So RBI acts as a banker to the government. We already know about this. We already discussed about this in the banking sector. It receives and pays money on behalf of the government. If the balance goes negative, RBI lends short-term interest-bearing advance. The key point to note is that it is interest-bearing. So the central government will pay interest to the RBI, to the government. This is called a wage and means advance. So means, wage and means advance. Advance means a short-term loan. Advance means a short-term loan. Special floating and other loans. Floating loans basically mean where the rate of interest is not fixed. The rate of interest keep changing depending upon a particular factor, right? So this is the floating loan. So these are loans to raise money and their interest is subject to revision periodically. So interest rate is revised, right? So if we say fixed interest rate, that means the interest rate which was fixed at the time of giving the loan. And floating interest rate means the interest rate is revised as per the agreement between the loan giver and the loan receiver. Then we have securities against small savings. Securities against small savings. So there are various small saving schemes of the government. For example, Kisan Vikas Patra, etc. and so on and so forth. So against these small securities, the government issues, against these small savings, the government issues various securities. So these securities are also part of the internal borrowing, and out of this fund, 20% of amount is invested in the central government securities. Compensation bond. So various kind of bonds are issued by the government to compensate for various things to the individuals or the institutions. So bonds issued by the government to the affected persons by its policy decision. So many times you might have heard about the land acquisition policy. So when government builds some infrastructure project, the government might require the land of the different individuals. So at that time the compensation bond can be given to different individuals, right? Multilateral loan. Multilateral loan is part of the external borrowing, right? So this multilateral loan and bilateral loan, they are part of the external borrowings. External borrowings means the borrowing from outside India. So multilateral loan means loans received from multilateral agencies like International Monetary Fund, World Bank, etc. Bilateral loan, the loans raised from the foreign governments directly, right? So foreign government, it is basically bilateral means from one country to another country. So when India is taking the loan from USA or Japan, right? So that particular loan is called bilateral loan. Now this small saving scheme, this is part of the other than borrowing receipts, right? So in the capital receipts we discussed that capital receipt can be of two categories. One is debt receipt, another is non-debt receipt. Inside the debt receipt there can be two kind of receipts. One is the borrowing. Borrowing can be internal and external. So till now we have discussed internal and external borrowing both. Another category inside the debt receipt is the receipt other than borrowing, but they are part of the debt receipt only. So those are the receipts which have been kept with the government by the general public, but Actually they are not the borrowing. The government is not going to the general public to raise that money, right? So they have been kept by the public. So these are the small saving schemes. So the small saving schemes currently in force are, for example, post office saving account. So for example, postal department has the saving account of the individual. When individual deposit this money in the post office saving account, this money is kept in the small saving scheme, because this money has to be returned back ultimately to the account holder. Therefore this is a debt receipt. This is an obligation which needs to be returned, right? This is an obligation which needs to be returned. Post office time deposit. So what is the meaning of time deposit? Time deposit means whose duration is long and which are generally not withdrawn by the account holder before the expiry of the maturity, right? So there are two kind of deposit. One is demand deposit, means the deposit which can be withdrawn by the account holder on the demand. That means at any point of time the account holder can go to the post office and withdraw the money. Time deposit means a kind of fixed deposit. The person has deposited the money for at least certain period. The period can be 6 months, 1 year, 2 year, and the withdrawal can be done only after that period unless and until there is some emergency. Post office recurring deposit. Recurring means which happens again and again. So every month the person is depositing 10,000 rupees. So this is a recurring deposit. So all the post office accounts, they are the small saving scheme. Why they are part of the small saving scheme? Because they are not the post office is not a bank. So in the recent time the India Post Payment Bank has been opened, but Post Payment Bank is different from the General Post Office. The General Post Office is basically representing the government of India. That is not a bank, right? We are talking about that. Post Office monthly income account, senior citizen saving scheme, national saving certificate. So these are the saving certificates, saving instrument where general public deposits the money and public knows that because this money is lying with the government, it is completely safe. So for the purpose of safety of the money, this amount is deposited by the government deposited by the public in the different kind of saving instrument. National saving certificate and public provident fund. Even the provident fund amount is also part of the small saving scheme. What is the meaning of provident fund? Provident fund is basically the monthly payment which is deducted from the employee's salary and deposited in an account. At the time of resignation or at the time of retirement, this amount accumulates and this given back to the individual, right? And also not only the individual or employee is depositing the money, but an equal amount is also deposited by the employer. So this is provident fund. So provident fund, it includes general provident fund and state provident fund, right? Other accounts, deposits of non-government provident funds. So the private sector government funds basically, right? So these are also part of the other than borrowing, and this is also other than borrowing. Reserve funds. These are funds created by departments to iron out excessive variations, undue fluctuations in revenues by using it as a buffer. So this is a kind of emergency amount which is kept by the government, and this is called reserve fund. Here you can see in the first part of the slide, this picture I have taken from the Union Budget 2021, which was introduced in the month of February 2020. So here you can see different items of receipt. In these different items you can see borrowing and other liabilities. So these are the borrowing and other liabilities. Borrowing, it can have internal borrowing, external borrowing. Other liabilities we have seen small saving account, provident fund, etc. Then we have this GST receipt, we have this corporation tax, right? So they are basically capital receipt, and these are the tax revenue items. Non-debt capital receipt we have yet to discuss. They basically include the receipts like disinvestment, the receipts like repayment receipts, right? Union excise duty, income tax, customs, right? So these are various items. In the second half, expenditure item have been given. Since we have not discussed the concept of expenditure, therefore we will not discuss as of now. Now coming to the revenue expenditure, right? In fact, before revenue expenditure, I should discuss this non-debt capital receipt, because this part has been missed in the slide. Non-debt capital receipt. So in the non-debt capital receipt, first there is disinvestment. Disinvestment means the government is having shareholding in many government companies. When this shareholding is sold to some other person, the government receives the money in lieu of that. So this is called disinvestment. Disinvestment. So investment is basically sold by the government. So these kind of receipts are basically called disinvestment. We will discuss this concept of disinvestment separately in a different session. So don't worry, you will get everything. Number 2, repayment receipts. So central government gives various kind of loan to the government agencies, to the state government, etc. When this loan is given to them, at that point of time, this is capital expenditure. But when this amount is received back, this is capital receipt. So this is basically nothing but the repayment of loan received from the state government or other agencies to which the central government gave the loan earlier. Right? Now coming to the expenditure part. So till now we have covered the receipt part completely. Now we will discuss about the expenditure part. In the expenditure, there are two kinds of expenditure: the revenue expenditure and the capital expenditure. What is the meaning of revenue expenditure? Revenue expenditure means the expenditure which does not impact the asset and liability, and which is normally incurred for day-to-day functioning, right? So revenue expenditure which does not result in creation of asset for the government. This includes the expenditure incurred for the normal running, for example, salaries, for example, interest payment, pension, etc. Expenses incurred to provide various services, making interest payment on debt, grants in aid, meeting subsidies, etc. Generally, all the grants given to the state government or UTs and other parties are also treated as revenue expenditure, even though some of the grants may be used for the creation of capital assets. So this point is very simple. Suppose central government gives various grants to the state governments, right? Now this grant, it can be used by the, this is the grant basically to the state government. So this grant can be used by the state government for day-to-day functioning, or it can be used for any asset creation. So utilization by the state government does not define the nature of this grant. If this is a grant is basically kind of donation, it's a kind of gift, it's a kind of assistance, right? It is not a loan, right? So if this grant is given, this will always be classified as the revenue expenditure, right? This will always be classified as a revenue expenditure. It does not matter whether state government is utilizing it for revenue purposes or it is utilizing for the capital purposes. It does not matter. What matters is, if it is grant, it is always part of the revenue expenditure. Please make this point very clear, because many times the question has been asked from this portion. Again, there is one more point: loan. If central government gives any kind of loan, whether the loan is given for day-to-day usage or for any capital creation, this loan is always classified as the capital expenditure. Please be careful.